Goeiemôre almal. Dankie dat julle ingeskakel het en dat julle bereid is om julle tyd af te staan om te kyk na hierdie wat ek probeer aanbied. Hierdie is die eerste en hopelik gaan dit in die toekoms meer gebeur. So kom ons kyk wat hier uitkom. Oor 'n paar sekondes sal ons weer begin om die twee aanbiedings aan te bied. Ek het dit al reeds gedoen, maar ek sal dit nou weer saam met julle doen. Kyk gerus en julle kan agterna vir my vra as julle wil. Dankie vir julle deelname.
Now it is time for us to get into this big debate, and all the way from London in the United Kingdom, he is a few hours behind us, I think, but potentially some of his family might still be asleep, but he's awake, he's ready to get going. We've got Dominic Frisby. Let me introduce him real quick to all of you guys. He is one of the most respected financial writers of our time. He writes a weekly column on all matters financial and economic for Money Week. He also contributes to publications such as The Guardian and The Independent, and he's also managed to write 3 books in that time, including one entitled Bitcoin, The Future of Money.
So I was originally booked to do this conference before the word COVID-19 had even entered the lexicon. It was a long time ago, and I'm quite sorry not to be coming out to South Africa because I've always found it such a friendly country. Of all the countries I've ever visited, I would say it is the most friendly. And of course, since COVID happened, the rate at which money has been created, at which debt has been created, has accelerated quite dramatically. And the other thing that's happened in the meantime is that Bitcoin has suddenly got itself into the mainstream conscious in a way that it hadn't before. And I wrote the first book on Bitcoin a long time ago, back in 2014. And so it made sense. There's a lot of crossover between what's happening in Bitcoin and money printing. So it made sense to extend the talk into the area of Bitcoin. And there are 2 main themes to my talk. And these are the 2 things I want to leave you with, the 2 takeaways. The first is the effect on asset prices of money printing or the inflation of the money supply or debt levels, whatever you want to call it. That's part 1. And part 2 is the incredible scalability of digital tech. So let's start with slide number 1. And here, what I've listed out is some prices of everyday things. I've done it in US dollars because we're all familiar with America, because of Hollywood and so on. And I've listed out the prices of certain items back in 1971, and I've compared them to how much they cost today. And the reason I've done 1971, I've used that as a start date, was that 1971 was the year that the United States came off the gold standard. Until 1971, the US dollar was tied to gold. So in theory, only as many US dollars could be printed as there was gold to back them. In practice, it didn't actually work like that, but still, nevertheless, the fact that the US dollar was tied to gold put a certain restraint on money creation, and all other currencies around the world were tied to the US dollar. And then, of course, in 1971, with the Vietnam War to pay for and various expensive welfare reforms at home, the United States took itself off the gold standard. And ever since 1971, we've seen this incredible acceleration in the price of everything. It's worth remembering that in the 19th century, when the world was on a gold standard, if you compare prices at the beginning of the 19th century to prices at the end of the 19th century, everything was a lot cheaper because of improved productivity. The money supply didn't grow. Well, it grew at the rate at which gold was mined, but the improved efficiency of everything meant that prices actually fell over the period. And it was also one of the periods of the most incredible wage growth in history. But since 1971, we've seen almost the opposite, is that wages have increased in price, but everything else has increased at a much faster rate. So let's look at some of these prices. Firstly, we have the average income. In 1971, it was 10 grand. Today, it's just over 30 grand. So it's trebled in that 50-year period. A new house, on the other hand, has gone from 25 grand in 1971 to 375 grand today. So it's gone up by 15 times, much more than wage appreciation. Cars have also gone up by a considerable amount, by about 11.5 times. A university tuition, and in this case I've used Harvard because it's the most important university in America. An annual tuition in 1971 was $2,600. Today, it's nearly $52,000. It's gone up 20 times. A cinema ticket, everyday consumer good, has gone up 6 times. A gallon of petrol has gone up 9 times. Stamps gone up 7 times. And milk and eggs have gone up in price by about 3 times. Now, there are various things, all these items, some of these items have in common with each other. And the first thing to notice is that with income, there's no fixed supply of labour. With more women coming into the workplace, the labour supply has almost, I suppose you could say it's almost doubled. More immigrant workers, there are more and more workers. So there's no shortage of the supply of labour. And there's also no debt in the labour markets. On the other hand, a new house, there's a certain shortage of supply of new housing. Planning permission can be difficult to get. Of course, we build new homes, but there's rather more fixed supply of homes than there is in labour. The other thing to notice about housing markets is that we use debt to buy a house. And I'm often asked, how is money created in this new world of this post-gold standard world of fiat money? And one of the ways by which money is created, and in 2008, it was the key way by which money is created, is money is created when banks issue debt. So people think, let's say I buy a house for £1 million. People think that the bank has got £1 million sitting that it's waiting to lend to me. It doesn't. When I give it the deeds to the house, I've got a house that costs £1 million. I want a 900 grand mortgage. I take the deeds to the bank, and the bank creates $900,000 and lends it to me. And that thus is 900,000 rand created. That is how fiat money is created, by the issuance of debt. Today, it's also created by quantitative easing, but that wasn't always the case. And of course, by straightforward money printing, the printing of physical money. But physical money only occupies about 3% of all the money that exists in the world. 97% of money is digital, doesn't exist as cash. If you went into your local bank and demanded to take all your savings out, the chances are the bank wouldn't be able to give you that money in physical cash. So money is digital, money is debt. And because debt is created, that pushes up the price of houses. If houses was a cash economy, they could not rise to the same extent that they do. And of course, with zero interest rates and cheap debt and all those policies designed to lower the cost of debt, that means that even more debt gets created. Similarly, with cars, a lot of people use finance when they buy a car. The finance, again, helps push up prices. In reality, cars have got a lot better and car production techniques have improved. They should have fallen in price. There's no fixed supply of cars. But with the cost of debt, car prices go up. Harvard University tuition, there's a fixed supply of it. There's only so many places at Harvard. And we have student debt, by which that tuition is paid for. So those two factors work to mean that Harvard University tuition has outpaced all the other assets on this list. Cinema tickets, on the other hand, there's no fixed supply of them, and we don't use debt to buy them, so they've only gone up 6 times. Petrol, oil is much harder to find than it once was. It's not so readily available. That's pushed up the price. But again, the biggest driver of the oil price has simply been that there's more money floating around. Postage stamps, again, they haven't gone up by as much as tuition. There's no fix. In fact, postage stamps, again, should really have fallen in price with all the amazing new courier networks that are now readily available. But they haven't. They've gone up 7 times. Milk and eggs, farming techniques have improved dramatically in the 50 years. I don't think we had battery chickens, for example, in 1971. We do now. And it just means that eggs and milk have become incredibly cheap. We don't use debt to buy them. There's no fixed supply. And so they've only gone up by 3 times. So the overall effect of all this money creation that's gone on, whether it's by banks issuing debt or banks issuing debt or government suppressing interest rates or quantitative easing, all these different ways by which debt is encouraged and money is created, the overall effect is that everything has gone up in price. But certain assets, those where there's a fixed supply, a finite supply, and there's debt involved in their purchase, have gone up by much more. And next, we look at a chart now of the US dollar and the South African rand. This chart actually goes back to 1976, but it would be the same story if it went back to 1971. They have been terrible stores of value. What 100 rand or $100 bought you in 1971 compared to what it buys you now, they're just incomparable. So you were not well off holding cash. Of course, in the 70s and 80s, interest rates were high, so you were compensated for the loss in purchasing power of your money by good rates of interest, but they don't exist anymore. And, we were looking at US dollar prices now compared to 1971. The South African rand has been even weaker than the US dollar. Cash, it's useful in an emergency, but it's a terrible store of value. And here, in red, we see the US monetary supply, M2 money supply in red. And then in that golden color, we see the S&P 500, the most important stock market in the United States. And we can see that though the stock market is much more volatile than money supply, the two have appreciated hand in hand, lockstep. The more money that gets created, the more stocks go up in price. The same thing applies to housing. Here's the US housing market. Again, this only goes back to 2014, but you could take this chart back to 2008, the financial crisis, 2000, the turn of the century, or all the way back to 1971. The more money that gets created, the more houses, stocks, whatever asset it is, appreciates in value. And here we see the extraordinary levels of national debt. This is debt owned by governments around the world. In America, the biggest economy in the world, the reserve currency of the world, nearly $30 trillion in debt. It's an extraordinary figure. Now, we wonder, how much is a trillion? Numbers like trillion and a billion get bandied around. We forget just how big a trillion is. If I went back to the year zero, 2021 years ago, 1st of January, and I spent $1 million every day over the 2021 years since the year zero, I still would not have spent $1 trillion. And the United States national debt is closing in on $30 trillion. It'll be over $30 trillion before the end of this administration, perhaps even before the end of this year. And China, every country in the world has huge levels of national debt, and there's no way these debts will ever be paid back, except with massively inflated currency. In other words, currency that's dramatically lost its purchasing power. And around the developed world, debt to GDP ratios stand between about 90 and 110, 120% of GDP. The big exception to that is China, which is still at 50% of GDP, and Japan, which is at an extraordinary 275% of GDP. Now, when you look at debts and your head explodes and you think this is all going to collapse, I just want to buy gold, tins and guns and run for the hills. But you look at Japan with 275% of GDP and you realize just how long this can go on for. A lot of ardent inflationists predict imminent collapse, and they've been predicting imminent collapse ever since I began following gold in the early part of this century. And their arguments make sense, they seem to make natural sense, but the collapse never happens. Just asset prices carry on going up in value and the value of cash keeps on falling. And where does South Africa stand in all of this? South Africa's debt to GDP ratio is at about 80%, and it was 60%, just over 60%, 2 years ago before COVID happened. So in the course of COVID, it's gone up by 20%, a significant amount. South Africa is probably more vulnerable than the United States is, because it's an emerging economy on a relative basis. It's not the senior currency of the world. It doesn't have the protection of the US dollar or the euro. So that's the first part of my talk, ladies and gentlemen. The type of assets that have done best and will continue to do best in this environment of relentless money printing. Now, the next subject I wanted to talk about is the rise of the digital economy. And as we've gone from a physical economy to a digital economy, from tangible to intangible. And the physical economy, the tangible economy, has been growing at 1%, 2%, 3% per year since probably the 1970s, the 1980s. Obviously, it has bad years and good years, but there's been a sort of steady growth. But this growth has been eclipsed by what's happened in the digital economy. And the reason for this is and I'll just give you some stats to give you an idea just how much the digital economy has grown by. In 1990, the market cap of the 3 biggest companies in Silicon Valley, the combined market cap, was $36 billion. And they had about 1 million employees between them. Today, the combined market cap of Google, Apple, or I should say Alphabet, Apple and Facebook, the 3 largest companies in Silicon Valley, is $4.7 trillion. It's 130 times higher. And yet at the same time, they employ a quarter as many employees, just 25% of the number of employees. The digital economy has done incredibly well. And the reason for this is the scalability of digital. And let me use a really childish, if you like, analogy. When I was a kid in the 80s, if I wanted to record an album, I would play the record and then I would record it to cassette. And if I wanted to record 5 or 10 copies of that, I would have to do that 5 times in real time. Or I would have to get 5 cassette players and put them all on top of each other. Now, with digital technology, I can just go copy, paste, and send that same MP3 or WAV file out to 10, 15, 1 million different people if I want. I can let's say I invent a brilliant new widget. Like I've got a little USB fan here on my desk to keep me cool. If I invent the best fan in the world, I've still got to manufacture those fans and distribute them all around the world. So I need factories and distribution, logistics, and all the rest of it. But let's say I invent a brilliant app. I can just upload it to the App Store and it can be downloaded 1 million or 1 billion times. And so the profit potential of an app, some kind of app, some kind of digital technology, because of this replicability versus physical goods, is one dwarfs the other. If Google wants to make a change to its search engine, it just changes the code, uploads it, and boom, 1 million or 1 billion people or 7 billion people or however many people there are that use Google can benefit from the new improvement to its search algorithms. So there's an instantaneous replicability that to digital that has just given it tremendous scalability. And the internet and everything that's come with it has only increased that. And you look at the valuations ascribed to Amazon. I think, I would need to check this, but last year, Walmart's revenues were still greater than those of Amazon. I didn't list Amazon, by the way, in Silicon Valley because it's actually based in Seattle, not in Silicon Valley. But Amazon gets far greater valuations in the marketplace than Walmart does, even though Walmart has the greater revenue. And so it's because of this scalability of digital, because of the quick return investors get on their investment in digital, it attracts more investment. And so you have a virtuous cycle. And then in 2008, there was a great breakthrough. So Bitcoin has come along, a digital asset in a digital world, and it's done extraordinarily well. And one of the reasons that Bitcoin has done so well is that it solved a problem that had flummoxed computer programmers for 20 years or more, which is the concept of digital scarcity. We talked about the digital instant replicability of pictures or emails or MP3s or whatever it is. But imagine if you could copy and paste money. It would lose its value instantaneously. And so people thought it wasn't possible to have a digital cash because there would be, people could just copy and paste it. The only way to stop there being a digital cash was be to use some kind of middleman to process the transactions, like a bank, at which point it's no longer cash. It's another form of money. The point about Bitcoin is it's digital cash. It has a transfer from me to you, from A to B, with no middleman. That's the point about digital cash. And the reason that got computer coders so excited is that Satoshi Nakamoto, Bitcoin's inventor, solved the problem of digital scarcity. In this instantly replicable world, he found a way of limiting the supply of a digital asset. And his solution, his means to do this, was the blockchain. And, you know, it's an incredible breakthrough technology. And that's why Bitcoin has done so well. It's a digital asset in a digital world that provides digital scarcity. And here we see the Bitcoin price since 2015, and it's been one of the most astonishing economic success stories ever. As I said, I wrote the first book about Bitcoin back in 2013, 2014, and I researched the first ever price of a Bitcoin, and that was in 2010, 2011. A guy called New Liberty Standard, that was his internet name. He calculated the Bitcoin price by dividing the number of Bitcoins his computer produced, his computer mined, by the amount of electricity it used. And he calculated that there were roughly 1,200 Bitcoins to $1. Fast forward to today, and there are roughly $50,000 to one Bitcoin. So the value of one Bitcoin from 2011 to today has gone up roughly 50 million times. If you just bought one Bitcoin in 2011 or got hold of one, and it's almost like winning the lottery for some of the early adopters. It's just been incredible. Obviously, the price has come back now in the last couple of days. I think it's at about 46,000, but it's a volatile asset, but the general trajectory is up. So Bitcoin was invented in 2008. It was invented in reaction to all the money printing that was going on. The inventor, Satoshi Nakamoto, wanted to create a form of money that, for the internet, that governments couldn't print. He wanted to create a deflationary system of money. In other words, that it wasn't, the supply of that money couldn't keep increasing. In other words, it would keep its purchasing power. Its purchasing power would increase over time. It's a sort of digital replication of gold. It was a new system of money for the internet. As I said, he solved this problem of digital scarcity. The inflation rate of Bitcoin is transparent. It's there, set in code for everyone to see. It's widely known that this many Bitcoins will be created at this rate over time. It's all set in code. And there's a finite supply of them. There's only ever going to be 21 million. At the moment, I think something like 19 million have been created. So there's still another 2 million to be created over the next few decades. And its value is set completely by the market. Now, I want you to consider this idea of stored energy. When you work, you expend energy and you get paid in money, which you can later, which is a form of stored energy, if you like, that you translated your effort into money, and you can later use that money to buy whatever it is, some good or service, which is the result of somebody else's efforts. And Bitcoin is created, so money is a form of stored energy, if you like, And Bitcoin is created, it involves vast amounts of computer power to create Bitcoin, to process and maintain the network. And so one way of looking at it is it's a form of digital stored energy. So there we go. Now, I spoke to 4 South African asset managers about investing in Bitcoin last week. And by the way, I should say, I'm a massive Bitcoin bull. I think it's a fantastic technology, but I don't necessarily think it's something that asset managers should be offering to their clients, if that makes sense. And I'll explain why in a moment. But anyway, I spoke to 4 South African asset managers about investing in Bitcoin last week, and here is what they had to say.
Retirement fund rules in South Africa do not allow for investments in Bitcoin or other cryptocurrencies. If it was allowed, would you consider it for any of your funds?
In their current form, no.
No. The key issue for us right now is the lack of a kind of firm regulatory framework around Bitcoin and the safety of clients' assets.
Yes, I would definitely be. So in my mind, there is definitely a space for Bitcoin in I think probably most portfolios.
What's your response to investors who want to include Bitcoin as part of their investment portfolio?
So I'm a libertarian, so I feel that if they want to take a gamble on a small part of their portfolio, they may, just as long as they acknowledge that it's a highly speculative asset.
Yeah, I'd say, well, make sure first you can stomach the volatility. I mean, in the last 12 months, Bitcoin went from $10,000 to 65,000, back to 30. Now it's over 50 again. So, that's not for the faint-hearted.
They need to be careful because it's speculative and they get no regulatory protection.
I think that Bitcoin needs to be evaluated the same as any other currency, commodity or asset. Investing in Bitcoin is not speculation. It's only speculation if you don't know why you are investing in Bitcoin. So educate yourself.
If an investor is going to invest in Bitcoin, what is the maximum percentage they should consider?
As a really rough rule of thumb, I'd say 5%.
Probably about the same amount that you'd take to the casino with you and play red or black.
No more than they can afford to lose in their portfolio, whatever percentage that is.
I'd say 5% until you're comfortable with the risk.
If you had to allocate 5% of your portfolio to gold or Bitcoin, which would you choose?
I choose gold.
We know that over the long term, gold's a good hedge against inflation. We've got no idea what Bitcoin hedges.
Gold, no doubt.
Definitely Bitcoin. The medium of exchange used by humanity has evolved through time, from shells to beads to gold to paper. And Bitcoin is the next natural evolution in that process.
For South Africa investors, what are the biggest risks when it comes to investing in Bitcoin?
The regulation and reporting requirements of cryptocurrency platforms and coins is, in my mind, light years behind that of traditional financial institutions. So investors need to be wary of scams and of fraud.
There's no kind of formal regulatory framework for Bitcoin. And then, of course, the use of Bitcoin by criminal networks.
Volatility, theft and fraud. And I'm distinguishing between theft and fraud.
The South African Reserve Bank and South African government, and I guess internationally, reserve banks and central banks and governments adopt a more prudent fiscal and monetary policy, which would mean that the investment case behind Bitcoin weakens.
Bitcoin's price has risen exponentially in the last decade. What do you think has driven it?
Bitcoin attempts to fulfill this libertarian fantasy of a private currency, and as such, its valuations are driven by fantasy.
Concerns about fiat currency and whether this might be the new monetary order.
Low interest rates around the world, a lot of liquidity coming from central banks, so the stimulus that you've seen, and of course, it's a very, very attractive technology. It's very exciting.
I think the price action in Bitcoin, that we're seeing is the rapid adoption of a disruptive technology.
The cryptocurrency debate has been well covered in the media. Which aspect of the debate do you think is most missing?
Viable fintech and online payment methods that are pushing the market to transact in new and exciting ways.
And the two which I think really need to be focused on are issues of valuation anchors. How does one actually come up with a view on what Bitcoin and other cryptocurrencies are worth. And the second one is the issue of regulation and safe custody.
I think we need to pay more attention to the carbon footprint of producing cryptocurrency.
I think what's missing from the debate is the counter-argument to the intrinsic value obstacle quite often put forward by fund managers. The intrinsic value of Bitcoin is that it is 100,000 independent nodes that allows anybody to transact 24/7 without having to have the trust or approval of any third party. And in a world that is becoming increasingly polarized, Bitcoin is completely non-political. It has the potential to run as a reserve currency for the world, and the intrinsic value really of Bitcoin is freedom.
So it's important to remember that Bitcoin was invented to be an alternative financial system. It was invented to be a money outside of the traditional financial system. And you guys are operating in the traditional financial system. Now, to use Bitcoin, you've got to get involved with keys and wallets and cold storage, and there's all sorts of problems that you can have with it. It's not that easy. And it's not necessarily something that you're trained to do. So even though I recommend that everyone own a little bit of Bitcoin, it's something that should be done personally. You hold your own keys. You take charge of your own finance. It's not something I think necessarily that should be done at the asset manager level, because apart from anything else, the asset managers are taking all sorts of technological and custodial risk on that they might not necessarily be trained to deal with. The other issue is we saw that El Salvador this week made Bitcoin legal tender. The more governments print and the more successful Bitcoin is likely to be, but the more successful Bitcoin is, the bigger a challenge it presents to existing government money systems. And so the more likely it is, particularly in authoritarian governments or corrupt governments, that it gets made illegal. They recently made it illegal in Pakistan, for example. Now, as soon as they made it illegal in Pakistan, Bitcoin usage actually increased. But there is a genuine risk that Bitcoin is made illegal, at least in certain countries. I don't know if that's a realistic possibility in South Africa, but, you know, who knows? This is 2021. Anything's possible. And even though use increased in Pakistan after they made it illegal, you are properly qualified asset fund managers. You probably shouldn't be dabbling in something that's illegal. There's too much risk to you, and you know you're not allowed to break the law. So, you know, there is, despite its enormous potential, there is technological, custodial, and regulatory risk to Bitcoin. That completes my presentation, ladies and gentlemen. Thank you very much for watching, and thank you to everyone at Allan Gray for inviting me to come and speak to you. And hopefully I can do that at some point in the future in real life. Until then, cheerio.
And thanks everyone for listening to the presentation. It's quite a broad topic, and I think the one thing we can say for sure is that no one knows what's going to happen. And I think that's why I've always heard investing best described as a probability business. Now at Allan Gray, we bottom-up investors, but we do think a lot about, and we definitely want to be on the right side of long-term trends, and both on the extremes of valuation and economic variables. And the sort of scenario I'm going to be focusing on today is increased inflation. Now, we all know there's been a massive increase in monetary supply in the world through quantitative easing that dwarfs the response to the great financial crisis. In fact, if we just put the Fed buying into perspective, you could buy the whole of British American tobacco and Richemont every 37 days with what the Fed is spending in the market. Now, that has been combined for the first time with fiscal spending, and so what I kind of see is a higher chance of inflation coming through into the future. Now, this increased inflation, particularly in the developed world, will show through in higher nominal dollar commodity prices, and this will be exacerbated by ESG policies. And what I mean by exacerbated by ESG policies, well, it's raising the cost of capital for resources as well as capital-intensive industries. South Africa, I think, will be temporarily buffered by the higher commodity prices. And I see from the Molangela's presentation that he'll be talking about that as well. Now, in South Africa, we're used to inflation, and I don't think a lot of people put enough thought in. We have inflation in South Africa because we're expecting inflation. Now, that's very different from the rest of the world. If you've been managing money in the developed markets, you've really only been managing money for 2 decades in a disinflationary, declining interest rate environment. And I've in fact heard this best described by Russell Napier, a financial economist, and he said they asked him, if you believe in inflation, what are you sort of advising your developed world clients to do? And what he said was, I think you should fire all your portfolio managers and replace them with Brazilians. And what did he mean by that? He meant, well, Brazilians have actually been in countries, just like South Africa, where we've had inflation, we've had currency crises. We worry about our governments. We worry about our country. So the one big risk from the scenario I sketched is your fund manager may not know how to manage money in a different environment. We potentially also face stagflation. And what I mean by stagflation is when we have low economic growth plus high inflation. That's really the worst kind of world that we want to be in. And we kind of look at history. When inflation goes up, we expect interest rates to go up. But what has happened is governments in history have applied financial repression. What do we mean by financial repression? Well, there you have governments and official agencies trying to keep interest rates low. How do you do this? You do this by yield curve control. In other words, central banks just go and buy tons and tons of long bonds to try to keep the interest rates lower. Or we have legislative changes. And in South Africa, we would call that prescribed assets. So that's when the government says, listen, if you're a pension fund, you have to buy this much government debt. If you're a bank, if you're an insurer, you have to hold a minimum of government debt on your balance sheets. And in that way, they try to keep interest rates down. But I think it should be obvious to everyone that the more and more money printing you have, the more and more you fund the government becomes bigger relative to the economy over time, and it doesn't pay any price for that. And I think, especially as South Africans, we know the risks that are involved when a government becomes too big relative to the economy. Productivity tends to decline quite significantly. Now, with this printing of money, and I think we've seen this over long periods of time, in times when money is being printed, people tend to lose faith. There's something wrong. How come I have to work for 10 hours to earn my salary, but someone can just print money in a few minutes? It just doesn't kind of make sense to people. So we have this growing inequality in the world and in South Africa, where people who own assets are getting wealthier, and people who don't own assets are getting poorer as a result of these quantitative easing policies. So what I predict in the future is there's going to be far more focus on redistribution in politics, and there's going to be far more focus on rules that favor labor over capital. Now, you might say, how does this pertain to South Africa? We already have a very redistributive economy, but I think it gives the government cover when they say, oh, well, we're doing this in America, we're doing this in Europe. Let's introduce basic income grant. Let's introduce further social grants and to increase that redistribution. I guess the thing that worries me most when I think about the risks of the scenario I've set out is every time I've gone and read up a lot about inflation recently. I mean, we don't know if it's going to happen, but every big inflationary episode has been sort of associated with social unrest, social instability. Whether it's 1920s in Germany, you can go back and look through history, the 60s and the 70s in the US. So again, I think this speaks to greater redistributive policies, and again, more sort of rules and legislation that favor labor over capital. Now, I mentioned ESG, and I think obviously it's a massive trend, and I think it reinforces all these trends. And that's why I meant by the title of my presentation, A More Divided World. People, when they think about ESG, focus a lot on the E, right? Because that's an easy thing. You can see it on a TV, you switch it on. But I think the S, social, and the G, governance, are going to become a lot bigger as we go forward. And within G, governance is not just looking at the boards of companies. I think it's going to become particularly more focused on politics. Now, unfortunately, we had to send in the topics of our presentations many, many months ago, so it's before what's happened in China over the last month. But one of the things was going to say the world is going to become completely and more polarized. You're either going to be part of the West or with the US, or you're going to be part of China. I think I know which side South Africa is going to choose. I'm not sure it's the right one, but I think the world is going to be increasingly polarized. Now, why is this important for South African equity investors? Well, it's something we've been talking about for a number of years. We haven't been proven correct yet. South African equities has a massive direct exposure to China. And what do we mean by that? Well, the big 5 shares on Naspers Process, Richemont, BHP, Anglos, they are directly exposed to South Africa, either through being in China like Naspers, or through the commodities they sell to them. And then, remember, we are indirectly exposed to China on quite a long way because they are the people who buy the commodities we sell, the iron ore, the coal, the PGM metals. That allows us to run a trade surplus. It allows us to keep spending in the economy. Now, that could reverse at any time. And what's particularly interesting for me when you look around the world, and the investment team, Allan Gray, given the events recently, we've been spending a lot of time thinking about China and what's changed, and is it a permanent change? Speaking to our colleagues at Orbis in Hong Kong, which I guess is China these days, and you can have a look. There are various big Australian superannuation funds which have now excluded Chinese assets from what their asset managers are allowed to invest in. And if we look in the US, there's quite a push for companies like MSCI, et cetera, to exclude Chinese equities from their indices, because many passive funds follow those equities. So that's very interesting. We don't know if it's going to happen, but I do think this has a direct effect on the stocks in many of our portfolios. So what can we do about this? Right? I've sketched out, what could happen, what are the risks, like what can we do in the portfolio, particularly if we're not sure what's going to happen. Now, my colleague Rory later will be talking about some specific South African shares, but what we can do, especially in our balanced portfolios, is tilt the portfolio, right? Tilt it towards the scenario I've sketched out and the probability that it happens. But I do want to point out something, and I hope it's clear to everyone, that if it's obvious that there's a risk in the market to all the market participants, it's going to be very expensive to hedge because everyone knows about it already. So when I think about how our portfolios are positioned, including the offshore portion of the portfolio, I think it's important to think of 2 other things. The other thing is, 1, what has worked since the GFC, and remember that's almost 12, 13 years ago, may not be what works in the future. Right? So a lot of people, and I wish I try to find the study with the stats, but I think it's less than 15% of people who manage money today have ever managed money before the GFC. And that comes back to my earlier thing. The risk might be that your fund manager just doesn't know. All they've been doing is interest rates go down, inflation rate goes down, the Fed has your back, you've never managed money in a different environment. The other thing, if we look back at history, is you have these very big changes in leadership that tend to last a number of years. So you only have to make a few big decisions. And what do I mean by that? Well, we went from the Nifty 50 shares, then it was commodities, then you had to go from commodities to Japan, from Japan to emerging markets, from emerging markets to US tech, then into financial stocks and banks, and then what I would call the last 6 or 7 years, the e-commerce and IT disruptor stocks. And you only really had to make 6 or 7 decisions in an investment career spanning decades, and you would have been correct. Right, so that's all nice, Duncan. What do we do about it now in the portfolios? 1, I think active management is going to make a big comeback against passive, right? Why do I say that? Because I think in the scenario I sketched, you can't be running a benchmark cognizant portfolio the way people have over the last number of years, and you can't look like everyone else. The other thing is, we want very little or no exposure to offshore sovereign government bonds. So we have virtually 0 exposure to any developed world long bond, and at the same time, because of quantitative easing, the spreads, in other words, the interest rate you pay on a risky loan over what you pay to lend to the US government, they've been compressed to almost the lowest in history. So, we think the portfolio must be actively managed. We don't want exposure to long government bonds or high yield bonds. And then we need to think about, well, how do we gain exposure to this sort of change in leadership, whether it's the unintended consequences of quantitative easing, whether it's ESG, whether it's the energy transition. Like, how do we think about this? So as an example, I would be over the next decade underweight the technology and the disruptor stocks that have been so strong over the last 10 years. Many people forget Facebook, Alphabet. These companies didn't even exist when their last IT bubble happened in the year 2000, right? And look where they are today. So we don't even know who the winners are going to be in the next 10 years. I think a portfolio should be long suppliers and producers of metals that are used in the energy transition. And we have written quite a lot about why Glencore fits this, we think, very, very nicely. I think you also need exposure to precious metals and precious metal suppliers. And what we don't know, and as I mentioned, if people know a risk, it's already in the price. But maybe some of the gold and the platinum shares are actually relatively not such expensive options on the world I have sketched out there. It's very interesting if you look at the long work Bank of America did on how to protect yourself against inflation. Interestingly enough, the number one way to protect yourself was to own platinum. That doesn't mean it could happen in the future, but it is something to think about. I think the other thing you can do is, if you're a bottom-up manager, is look for very, very specific things that can enforce an investment case that don't rely on all these big things. And the example I use here is the move to omni-channel retailing. So if you look at a lot of the department stores or retailers offshore, they've massively underperformed. And then all of a sudden, one day, people wake up and they have more online sales than offline sales, and they have only a good store base left, and all of a sudden they re-rated massively. Now, just use an example of bottom-up research. I think something like that could be Country Road within Woolworths. When people speak about Woolworths, they only speak about the clothing business and the food business. No one ever speaks about this business that generates far more than R1 billion of operating profit and is making almost 40% of its sales online. So I think Woolworths own a potential omni-channel retailer that could be very valuable. The other one could be, well, if you are worried about redistributive property policies, how can you protect yourself in South Africa other than, I guess, taking your money offshore? Well, you could own PEP, right? So the more there's a basic income grant, the more social grants increase, a whole chunk of that just finds its way into the top line of PEPCO. So I hope that gives you some idea about how we think about hedging it in South Africa. Now, what about this big China risk? It's something, if you ask me, what do I worry about by far the most in the portfolios? And I think the events of the last month and a half have really brought that right to the core for South African managers. So you don't have to own those big 5 diversified companies. Well, what about British American Tobacco? Not only is British American Tobacco cheap, gives a yield very high in pounds, but there's one very important thing about BAT. It has zero China exposure. And why does it have zero China exposure? Because its assets were nationalized by the Chinese government, I think, in the 70s. So there's a nice way we start changing the risk. And then if we look, well, why don't I take some of my money that's in process and Naspers, and why don't I move some of it into AB InBev, the biggest brewer in the world? AB InBev has been a terrible investment since it had the big takeouts of SAB Miller. So there's another way where we can start changing this reliance on China. And I do think then, when we think about the ESG, it's not that similar. It's not that similar or not that easy when we come to China. We only have to look at the experiences of H&M, of Nike. When they try to speak up about human rights abuses in China, boom, all their stores are closed. There's sort of vandalizing of the stores. So this is a very difficult thing that companies are going to have to navigate. So what about the ESG? Just to finish off with, I think the one thing is everyone's going to have to think a lot harder about the absolute size of their Naspers and process positions in their portfolio. And then I think there could be a lot of things, unintended consequences of ESG. We only have to look at the performance of thermal coal over the last while. I mean, no one wants to be in coal, but the thermal coal price has gone up massively. And we saw when it was very cold in Germany, well, what did the Germans have to do? Well, they didn't have enough coal for the base load of their electricity, and they had to go and get energy from Mr. Putin. Now, what is worse, having a little bit more coal or making Germany subservient to Russia? I think these trade-offs are going to be quite complicated, but I think the one commodity that could do really well here is oil, right? So people just don't want to own oil, but I think, that trying to push demand destruction and supply destruction, oil could surprise on the upside, just like it did on the downside. So why not have a little bit of Sasol in your portfolio? And we've done a lot of work at Allan. We think the best way to sort of benefit from ESG is to not buy the best ESG companies, because everyone knows that. It's to buy the ESG companies that are improving the most. So if you find ones that are improving relative to the past, they do better. And maybe just to finish off with, and this is from me, something personally, not Allan Gray, I do think in the scenario I sketched, it's going to be very important to have independent thinking. Independent thinking is kind of being crushed in the world, and if you're going to need to be different, you're going to have to think independently of the rest.
Baie dankie manne en dames wat gekyk het. As daar enige vrae is, daar's 'n plekkie waar jy gou kan vra. Andersins gaan ek, as ons klaar is, dit stop. En jy kan jouself uitlaat en later met my gesels as jy wil. Dankie vir julle wat gekyk het en dankie vir julle bywoorde.